The reforms proposed in the Vickers report have been described by some observers as the biggest changes, the biggest improvements to the banking industry in a generation. Are we teaching the world how to change things in finance for the better? Here to answer that question, Peter Hahn, expert in banking at Cass Business School. Peter, are these really the big things that they're being held at by the news headlines?
I really don't think so. On the one hand, the report addresses two major issues. On one side is really the financial stability of the banking system and lowering any risks and potential costs to the government and taxpayers. On the other side, they're also charged with trying to make the consumer and small business side of the banking system more competitive.
Well, that was what I wanted to ask you, because is it really possible to ring fence one part of a bank's operations, in this case the retail part, from the other part, which is of course described by media commentators as casino banking? A lot of people wouldn't agree with that, but can you actually separate the two?
Well, essentially, I think what they're asking is that the banks would have a holding company and own businesses, and have limit the amount of business that one subsidiary company, let's say the retail bank, does with its investment banking business, or for that matter, its subsidiary in another country that might also be another retail banking business. And conceptually, there's no problem doing that. The management issues with that are many. It's certainly by taking what's a business in one legal entity and putting it into several legal entities creates levels of complexity, additional costs, and whether some of those businesses become feasible to run on their own and the cost structures. Now, some of that has been addressed, and there was a discussion that it would cost several £billion into the system. And I noted when I heard some of the discussions yesterday on television and radio about it, that there were questions, who is going to pay that sum? And there were views that it would be certainly users of the banking system, but also the shareholders and people who provided credit to the banking system. And I largely disagree with that. I think all these costs will be borne by really the users of the banking system, and that's really everyone. And it just depends on which point of the banking system you're being used. But these are costs, in a sense, they're inefficiencies in the banking system.
What effect is this going to have on competition?
Well, the recommendations of the Commission are, one, that a large bank be set up out of what is the Lloyd's and Halifax Bank, that at least 600 branches, if not a greater percentage of accounts, be formed into a new bank. Now, that was already mandated by the European Commission shortly after Lloyd's and Halifax got state aid. So that's already going to happen. But the Commission points out that that should create a new competitor. And I think it asks a lot of questions about what is competition in retail and small business banking in this country. Now we have to stop for a second and think that retail and small business banking is very different country by country. It's not the same as large corporate or investment banking. And in this country, we now have 5 substantial banks that provide that. Plus, we've got 2 larger building societies, or mutually owned, or even a third one really that's mutually owned. And we have a number of small players. And usually that's a lot of companies to think about in an industry that should create a competitive environment. But there's a view that we don't have competition. And there's a number of, I think, misunderstandings about what competition is in retail banking. One of the things that we have in this country is that consumers don't pay a lot of the banking costs directly. So if we went to Spain or Germany for that matter, you'd pay for your Visa card. You'd pay when you take money out of the bank. You'd pay to have a bank account. Every year you pay annual fees, lots of fees. We don't have those fees here for directly. Now, merchants pay a lot of the fees when we use our credit cards, and that's in the price of goods we buy, but we don't pay directly. So there's a number of issues that they bring up. What is service? What more competition do they want?
Yeah, competition is working, arguably.
Well, it looks that way in many ways. Now, part of this question is, better service. Do banks make mistakes? Does it take a longer time? Do they sell you the wrong products? And one of the recommendations of the Commission is that one part of the old Financial Services Authority that's being broken up into what's called the consumer regulator is supposed to not only look after the consumer safety in products and reliability of what banks are proposing, sort of what we call conduct policy, but they're supposedly going to be charged with ensuring competition. Now, I come back and again try and understand competition in retail banking. If a bank was very nice to me and said hello, sir, and everything, and gosh, they couldn't have been nicer, would I pay them an extra 1% on my mortgage every year? Probably not. And in fact, for the average mortgage, I calculated this a long time ago, for the average mortgage in the UK, paying an extra 1% is the equivalent of almost £20,000 over the life of your mortgage. So service could become very expensive. So, as a consumer, what we look for is low rates on borrowing, and we look at higher rates on savings. And that's not necessarily the communications and things like that with banks. So what they want as competition is not really clear.
Peter Hahn, thank you very much.
Yes.